Hey guys, how's it going? Welcome to No Rats here. And today I want to talk to you about an investment strategy that I think that you can generate income pretty easily. But first, please hit that like button and subscribe, means a lot to me. And also, I apologize for the noise in the background. I got a bunch of kids in the swimming pool. All right, let's jump into it. So today, I think you may have heard of a concept called a covered call. And it uses the concept of options in your security portfolio. So for those of you who don't know who an option is an option to buy 100 shares or sell to 100 shares at a preset strike price. So these things are time duration. Basically, it gives you an ability to use leverage, so to speak, to purchase a security at a set price, or you can just take the profits with you. Now, the way we're considering using options is a form of income. And the reason I say it's income is that in this scenario with covered options, you're actually holding the security. So let's take a look at what I did with my portfolio. In my portfolio today, I own Roblox. Now, I accumulate up to 100 shares, and I'm just going to tell you a little bit why I chose Roblox. I actually like it. My daughter spends hundreds of dollars on these things, and it turns out that Roblox, I think, is one of those stocks where it's the new information age. Children are, rather than buying sneakers and whatever they did in the past, having great things, they're actually buying digital assets, and digital assets in the form of clothing or looking somehow to their peers in the game. So that's why I bought Roblox. Got to recoup that money back. That was my thinking. Well, I have, but I said, you know what? The stock is going down a little bit. In fact, today, a report from Benchmark came out saying that it's a sell to 75. So now the stock is actually going down. I purchased this option, one option to sell for someone to buy it at 95 for $5.50. As you can see, Roblox has been having a little bit of a rough time. I think it's going to expire worthless, in which case I keep the entire premium amount. That's how an option kind of works. Now I can roll this into the next month, right? Since I own the 100 shares, the option expires worthless, I'm going to buy the next one, get that income. As long as the volatility of the stock doesn't meet my stock strike price threshold, that option will not get exercised. Now I'm not going to get into the mechanics or the actual advanced mathematics of it. You can look up things called Black-Scholes. The key thing you have to understand about options is volatility. And volatility is that truly measure or what they call the standard deviation of whether or not that stock has a percentage chance to actually hit that strike price. Now, it's possible that somebody could actually call your option, but chances are at that level, they won't. Consider this as an option, quote unquote, or no pun intended, as a way to generate income off your stocks, right? Rather than just letting it sit there, if the stock is just kind of wallowing out there, constantly just not, very involatile, which some stocks are. Utility companies, for example, are like that. Just take the income off it, write an option against the security, obviously, and then if it ever gets exercised, if you really do believe in the stock, just buy it back, maybe buy it at a lower level. Now, this strategy doesn't work if the stock is actually going to be, if it's actually very popular and wants to rise up. But in most cases, you wouldn't probably do that if you're going to write the options on it. All right, well, thanks for watching. That's this presentation about covered calls, and get back into the next one. Thanks again.